Are we good to start? We're waiting for anyone else, Faisal?
I think all the media representatives are there.
Good.
When you're ready.
Great. Very good afternoon to all of you, dear friends from the media. Welcome to this press briefing of our Monetary Policy Committee that was held today. And today's committee marked the 60th seating of the Monetary Policy Committee. It is the first MPC meeting that we are holding since the full reopening of the borders on the 1st of October, which indeed marks a very crucial turning point in our economic recovery process. I will, as usual, start with a brief overview of international developments. So during the last MPC meeting held in August this year, there were already signs of global economic recovery. Developments over the past few months have further confirmed this trajectory. Economic activities picked up in many parts of the world, helped by the rollout of effective vaccine campaigns and the extension of strong policy support by both monetary as well as fiscal authorities. We are seeing demand picking up as economies reopen and sentiment improves across the board. The IMF, in its recent October 2021 World Economic Outlook report, the WEO, has projected global growth at 5.9% for 2021 and 4.9% for 2022, assuming that further progress in vaccine coverage will continue and accommodative fiscal and monetary support will remain in place. Travel sentiment has been improving lately also, with more economies adopting testing and no quarantine approaches. The outlook for global tourism looks very promising. Global trade continued to expand, even though the pace of growth has moderated, with supply constraints and freight costs acting as a drag. Global inflation remains above pre-pandemic levels and emanates largely from temporary factors that are likely to start fading away at the turn of this year. The Baltic Dry Index went up by 204% from September 2020 to September 2021. The FAO Food Price Index averaged 130 points in September 2021, rising by 33% from a year ago. As economic activity intensifies and markets become more buoyant, growth in advanced economies is projected to reach 5.2% this year. Growth in the US is forecast to stand at 6%, while that in the UK is forecast to stand at 6.8% for this year. With these growth rates, both the USA and the UK are expected to recover to pre-pandemic output levels within the next 2 years. Growth in emerging market economies is now projected at 6.4%. For low-income countries, the IMF estimates growth at 3%. Turning to the domestic front, despite the second lockdown, the economy rebounded by 19.3% in quarter 2 of this year, as against a contraction of 8.7% in the previous quarter. The high growth mostly reflected continued policy support by the central bank, the monetary authority, and the fiscal authorities, as well as buoyancy of some key sectors. In terms of sectoral performances, all economic sectors registered an improvement, particularly the manufacturing and construction sectors. On the expenditure side, growth was driven by higher private consumption spending and strong investment activities. Exports of goods turned positive amid higher external demand and domestic manufacturing activity, while export of services remained subdued. Imports of goods also picked up mainly due to stronger domestic demand. With more than 88% of the adult population vaccinated against COVID-19 as at this week, economic activity is expected to strengthen further, thus boosting business and consumer confidence in the economy. Key economic sectors, notably manufacturing sector, the financial services sector, construction, and ICT, are estimated to contribute positively to growth this year. Here, I would like to emphasize that the bank is keeping a very close eye on sectoral developments, and that I have personally met with representatives of the ARIM as well as that of MEGSA to be apprised of developments in these key sectors. Activity has been picking up in the second half of the year, and this positive momentum is likely to continue. The full reopening of our borders, as from the beginning of this month, is already showing key signs of revival for the tourism sector. From the 1st to the 15th of October, it is estimated that Mauritius has welcomed 30,000 inbound passengers, out of which more than 82% are foreigners. This is already creating positive ripple effects on the economy. Similarly, the manufacturing sector is seeing good order books, even comparable to the pre-pandemic levels. Going forward, the bank will continue to foster dialogue with key stakeholders of the economy for effective monitoring of real sector developments. The external sector is projected to recover this year, with the current account deficit as a share to GDP forecast to decline to about 10.2%, compared to 12.6% last year. Inflation remains contained, despite the recent increase in administered prices, such as for alcoholic beverages and tobacco and domestic petroleum products. Headline inflation stood at 3.2% in September 2021. As I alluded in my last MPC statement, we are in the same situation as many countries in the world. Inflation in Mauritius is driven by transitory supply shocks, in particular higher freight costs and commodity prices. There is still significant uncertainty on price dynamics worldwide due to such unexpected supply shocks, though global inflation is expected to fall in 2022. I now turn to money market developments. The bank continues to manage excess rupee liquidity in line with its monetary policy stance. Short-term yields have remained within the interest rate corridor in Q3 this year. Since the last MPC on the 4th of August 2021 to date, the bank has issued securities aggregating 36.1 billion Mauritian rupees. In comparison, since the beginning of 2021, the bank has issued a total of 80.9 billion rupees of securities. The level of rupee excess liquidity in the banking system evolved around an average of 26.5 billion rupees over the past 3 months, reflecting open market operations as well as foreign exchange interventions by the bank. The bank remains committed to pursue active liquidity management to ensure appropriate liquidity conditions as economic recovery gathers more momentum. On the foreign exchange market, conditions continue to be mostly driven by domestic demand and supply factors. Exchange rate movements of the rupee also reflected international currency fluctuations. The bank continued to intervene on a regular basis to address undue exchange rate volatility and ensure an adequate supply of foreign exchange to the market. It has sold to banks, FX dealers, and the State Trading Corporation a total of $1.1 billion since January this year, equivalent to around 46 billion Mauritian rupees. The bank has sold an aggregate of $2.4 billion since March last year. The bank continues to closely monitor conditions on the FX market and is committed to maintaining orderly conditions and retaining a floating exchange rate regime. Our gross official FX reserves remained at comfortable levels as well, standing at around $7.84 billion as at the end of September 2021, representing 19.6 months of imports. As borders reopen, with tourism arrival gathering pace and FDI flows increasing, we expect FX inflows to increase in the country. The level of the gross official FX reserves remains adequate according to the stringent ARA metrics of the IMF, ARA being assessing reserve adequacy metrics of the IMF. It stands well within the recommended range of 100 to 150%. I would here like to highlight that the bank has been engaging with the IMF in recent weeks for the assessment of reserve adequacy. The IMF will be revising upwards its assessment in the coming weeks. I also wish to provide an update on the new monetary policy framework which I announced. I'm pleased to inform you that the new framework has been worked out now and has been shared with the IMF. Consultations are ongoing and technical teams are currently working both at the level of the fund as well as at the level of the bank for the new framework to be finalized. From the perspective of financial stability, the banking sector continues to remain sound and stable. The sector has comfortable capital buffers, with the aggregate capital adequacy ratio standing at 18.6% as at the end of June this year, well above the minimum regulatory limits. Liquidity buffers are robust, with the liquidity coverage ratio of banks standing at 246.1%, well above the regulatory limit of 100%, as banks have been holding a relatively high level of liquid assets. The COVID-19 support measures are encouraging the flow of credit to the economy and economic recovery. The annual growth rate of bank credit to the private sector accelerated to 5.3% in July 2021 from 3.9% in December 2020, thus signifying enhanced activities and more business momentum. The credit growth momentum to corporates and households are sustained at 5.2% and 5.5% respectively in July 2021. The asset quality of banks remains sound and has improved further since December last year. The ratio of non-performing loans to total loans declined to 4.8% in June 2021 from 5% in March 2021 and 5.4% in December 2020. The extension of the moratoriums and some of the COVID-19 relief measures under the BOM support program up till June 2022 continue to provide financial respite to borrowers, especially those severely impacted by the pandemic. The total outstanding amount of loans to economic operators, SMEs, households, and individuals which have been granted moratorium due to the COVID-19 pandemic decreased to stand at 41.6 billion rupees as at the end of August 2021, after reaching a peak of 93.4 billion as at end of December last year. This decline in the outstanding value is a positive indication that the economic recovery is well underway and businesses as well as households are in a better position to service their debts. This drop also alleviates risk to financial stability. A further evidence of positive recovery is the drop in the amount of restructured loans since December 2020. The results of the latest stress test exercise suggest that the banking sector still remains prudent, capital and liquidity buffers to be able to withstand any potential shocks. The banking sector has successfully borne the effects of real economic shocks caused by the pandemic. The bank continues to closely monitor the resilience of the banking sector and conducts regular stress testing exercises and sensitivity analysis. I will now discuss the decision of the MPC held today. The MPC reflected on main developments shaping the current global and domestic economic landscape. Economic recovery is underway, and the growth momentum is expected to improve throughout the remainder of this year, especially with the resumption of tourism-related activities. Economic sentiment has improved considerably amidst vaccination progress and reopening of borders. In particular, the anticipated rebound in the tourism sector has lifted optimism over activity prospects, with economic operators expecting better prospects. Positive developments such as new flight announcements, increased seat capacity, and advanced hotel bookings are all pointing to a commendable outlook for the tourism industry. In view of the continued activity upturn across the global and domestic fronts, bank staff has maintained their real GDP growth of 4.4% for 2021. Sorry, 5.5% for 2021. Bank staff has revised its projection for headline inflation to about 3.8% in 2021, largely attributed to supply-side factors, including freight costs. With key trading partners purporting the recent rise in prices as transient, imported inflation would recede alongside an improvement in global supply chains. In the medium term, domestic inflationary pressures are expected to remain at bay. The MPC considers that the current monetary policy stance is appropriate. Accordingly, the MPC has unanimously decided today to keep the key repo rate unchanged at 1.85% per annum. The next meeting of the MPC is scheduled for the 15th of December 2021. As usual, I would like to underscore the commitment of the Bank of Mauritius to maintaining price stability and to achieving an orderly and balanced economic development whilst ensuring the stability and soundness of the financial system in Mauritius. The MPC will continue to monitor the economic situation closely and stands ready to meet in between its regular meetings if the need arises. I thank you for your attention and now welcome your questions. Sorry? Oh, no, no, no. It has well been factored in. Huh? I mean, the recent PRB announcement, you mean? No, no, no. It's been factored in. But I must tell you here, if you look at the past trajectories and the past, trends, whenever PRBs have been announced, it hasn't affected inflation in the country that much. I must say the immediate impact is not there. It's really scattered. So it has been well factored in our provision, and this is where we've come to 3.8% in terms of inflation forecast. So at the last MPC, I think we had announced 3.5. 3.5. It is now 3.8. As you're aware, I've been leading discussions with the FATF so far, together with all institutions which are concerned. I must tell you that we have accomplished our work as per the action plans that were suggested to us by the FATF, and this was testified by the plenary of the FATF back in June this year, where they acknowledged that Mauritius has satisfactorily completed its action plan. Later on, we had the opportunity of welcoming in Mauritius the delegation of the FATF Joint Group for an on-site exercise here in Mauritius. And since basically the process is ongoing, the plenary meetings of the FATF are being held currently as we speak, It started yesterday. It is ending tomorrow. I can say that as authorities in Mauritius, we remain confident, um, and we are all keenly awaiting for the official decision of the plenary of the FATF for tomorrow. The figures, I must say, speak for themselves. I mean, first 2 weeks, I think we've already welcomed 30,000 travelers nearly. When I speak with the key industry associations, as I've mentioned, ARIM, MEXAS, and some of the others also, they all point towards very good indications for their respective lines of businesses. And I have seen very little change, if not no change, in terms of the sentiment, which we are seeing. And this is what explains also why we are maintaining at the level of the bank our growth forecast for 5.5% for the year. And I must also say that we're closely watching all main indicators so that we can take informed decision as and when necessary. But the confidence is there, the sentiment is there across all sectors of activities, and we remain optimistic. I'm personally very optimistic about the economic recovery, and it is long awaited. I think around the world, when you look, it's the same momentum that is ongoing right now. And it can only benefit the country and all the citizens of our country as we all pick up and start living normal life again. Yes. Well, full recovery, I think, will only happen in the year towards the end of next year, or very beginning 2023, depending on the pace, of how we're seeing things evolving and the development of various indicators and factors. This is again something that we're very closely monitoring. Now that we are fully open, for travel, I think it will be the most instrumental quarter that we will have to follow to see where we can get very clear and significant evidences of in what direction we are really heading. And based on those evidences, we can then take more informed decision and more informed forecast as to when we will be back, to pre-pandemic levels. But as of now, as per the various scenarios that we're building, I think 2023 beginning would be where we can target to be pre-pandemic levels. But again, as I say, it all depends how quickly everything picks up. If we see more investors coming in, if we see more tourism coming in, it can happen much before also. It all depends on how quickly things are picking up. I must say, I've said that in the past also. It is a depreciation of the rupee that we've all experienced, not a devaluation. And there's a difference between both terms. Now, we are closely monitoring. As I said, since last year we've intervened already in the market to the tune of 2.4 billion US dollars. Not later than today itself, we intervened again $25 million on the market. So we are here. We are ensuring that there is adequate supply on the market. We are constantly liaising with all banks. I chair what we call an FX committee, which groups all CEOs of banks to closely monitor the evolution on the FX front. And we are here to ensuring that there is no undue or excessive volatility in in the movement of FX. I must also say that we continue to maintain floating regime. Increase the market is quite a lot of things, but certainly as the central bank, we are ensuring that there is no undue or very excessive volatility in our I think, yeah. You know, inflation, when you look at the way it is right now, it is caused primarily by supply side. Now, this, as you rightly say, is a point that around the world we are all we are all focusing on our central banks, and we're all, you know, very closely watching all evolutions. But the fact remains that the inflation that is being created right now is being driven by the supply side, and we are very much sure that next year, 2022 onwards, we will start adopting a downward trend, basically. Uh, and it is very transitory in nature. This is the state of all central banks around the world right now. So I do share the same views. And as it is, even the IMF came up very recently and mentioned that the inflation that is currently being witnessed all countries around the world are witnessing is transitory in nature. It is not something that is here to stay. It is not something that is here to be there in the medium term. Our central bankers, as monetary policy um, experts basically, we do watch the situation very closely, and our focus certainly remains on medium term rather than immediate or short term inflation. So as far as medium-term outlooks are there, so we should not be worried too much as at this stage. But again, as I say, these are things that we are very closely monitoring. I must also add that currently um, economies around the world are operating well below their capacity, their full capacity. So there is still room, for changes and evolutions to come. Good. If there are no further questions, I'd like to thank you for being here, and I look forward to continuously engaging. Thank you. Thank you.